Okay, very good morning. It's Tuesday, 25th of July. Just having a recap then briefly of yesterday's session, going through some of the kind of main news items from this morning and a quick kind of look ahead for what to expect for today. And I was off lecturing the best part of yesterday, so didn't sit at my desk to monitor markets fully, but one thing, just looking at the charts this morning and obviously reading through some of the research that's come in as well, it doesn't seem that there's been a great deal of action to speak of from Monday. One thing I did see was that from a statistic, the VIX, so that measurement of kind of volatility in the market, did hit an intraday low of 9.26, which is in fact an all-time low. And, I did have during the lecture I was delivering yesterday a question about, well, why is that so low when there is such inherent kind of risks out there globally on a kind of macro basis. And I guess one of the big things that we were looking at, because one of the subject matters I was talking about was European politics. And we were looking about what the market sentiment was, certainly at the beginning of the year, in that there was big risks surrounding the likes of the Netherlands, certainly France. There was risk about Italy, but as we well know, the far right movement in the Netherlands failed to capture really any backing at their election on March 15th, and then Macron, who's obviously pretty much the most pro-European politician you're going to get at this present point in time, helping fuel then forge a better, stronger relationship of unity in Europe with Angela Merkel. That then diminishes the risk for the German federal elections in September. And Italian kind of risk, although not gone away, has certainly, in those municipal elections we've had in the last month or two in Italy, certainly Pepe Grillo's five-star movement has started to, the support for them has faded slightly. So there's certainly a couple things there. I mean, this is just one area, but something which risk has fallen, certainly on what was one of the potential disruptors for 2017. And then, of course, overall, you've had this just fairly one-dimensional response, certainly in the equity markets, upward, moving to record highs, notably on the back of this kind of fiscal play from Donald Trump. And although we've been questioning Trump and his validity as president and his future to maintain his position in the White House, ultimately, what we're seeing is economic growth globally has started to improve. And in fact, what you're seeing is quite a coordinated global move where economic conditions are generally getting stronger over the last several months. And so maybe a lot of these factors helping keep that VIX kind of suppressed. Whether or not that will remain the case, I guess the longer this goes on, the more you'd be expecting potentially a little blip at some point in the future. Having a look then at something else that we had yesterday was some economic data coming out of Europe, and I've just been talking about generally conditions have been getting better overall from an economic data point of view, but we did have some slightly softer PMI numbers. These were important because these were the flash readings for July, and I guess they're going to be put into a little bit of context here. The Euro area manufacturing PMI came in a little bit softer, the lowest reading since March. Output expanded the least in 6 months. However, export order book remained solid. Pace of job creation was the second highest on record. So putting it here on a 12-month perspective, we are still very high, which is kind of, yes, we've peaked. We've kind of hit a bit of a plateau here, but ultimately this is well above where we were this time last year when we were just about in expansionary territory as far as these readings are concerned. From a service perspective, kind of a similar picture, a stark improvement from 12 months ago. A little bit weaker though on the print activity, maintaining June's pace, while new business though and employment rose at a slightly slower pace. It's maybe just coming off a touch which saw European equities trade a little bit mixed. One headline which probably came out yesterday, as I said, I wasn't here for the entirety of the session, but just catching up on things, was I saw the DAX underperforming slightly. The automobile sector was a laggard in the German components, or the sector breakdown, and these were the latest stories that were in circulation, allegations of collusion among German car makers. This, of course, comes after German car makers were already under quite severe pressure in the last, it's probably going back about 2-3 years ago now, originally when they had the emission scandal at VW, which then leaked into potential read across into some of the other makers. This is talking about engaging in cartel-like behavior since the early 90s, colluding on technical details on diesel exhaust treatment systems. So markets, individual stocks saw a bit of pressure on the back of that yesterday. Maybe just something to keep an eye on if you're a DAX trader, but I'd say overall this is more of a micro level story rather than something that's broader, moving the overall financial markets at this point. It needs to escalate a lot further for it to go to that situation, I'd say. But looking at the markets this morning and where we're sat, pretty uninspiring. The US futures are seen broadly flat. One thing that I did notice though on the charts this morning, which kind of does reflect a fundamental development, was yesterday. This was the open of Wall Street was around here. So we were trading around pivot. We moved all the way up to basically R2 yesterday. This is the NASDAQ 100 future. Remember, this week you've got the tech giants. Alphabet was last night. We'll have a look at those in a second. Then you've got Facebook and Amazon coming in the next few days. And we kind of rallied all the way up to what I believe was in the cash markets record highs again. However, as you can see, quite a clear and sharp fall seen after the closing bell. So of course Alphabet was in focus and their shares declined just shy of 4% after the market close. A couple real points of interest here were a lot of people looking at the fact that their revenues were a slight beat, but they fell short of the more optimistic forecasts on Wall Street. We've also Google have had to pay that 2.7 billion euro fine for monopolizing the market that we saw a few months ago. So that had a substantial impact on their profits as well. And then also they've been pushing into their costs have basically gone up in expansion into other ways and formats of advertising. And so not fantastic by any means. And this we'll be looking out for Facebook and then Amazon to follow in the coming days, but could be quite telling for price movement for the NASDAQ. One thing is though, we've pulled back and we pretty much sit at pivot now in the NASDAQ futures, and if you look at the other US indices at this point, they're basically flat in terms of the Dow and the S&P. Looking at the S&P, just from what the last really going back through Sunday night through Monday session, I guess the range has been kind of defined by what was yesterday's support at S1. We've got the low that was seen going back to Friday afternoon. That's kind of the trading band, if you like. You've got this 24.62 3/4 on the low, probably just above there, that kind of triple bottom seen at yesterday's S1. Then upside, the double top from yesterday, 24.70.5. So a bit of a consolidation pattern. This could well remain the case because, of course, tomorrow night we've got the FOMC meeting. And although I'd say the FOMC meeting is not going to be the most spectacular event, because the key thing about tomorrow's meeting is it's just a statement. We don't get the summary of economic projections, and we don't get the press conference of Janet Yellen. Of course, that happens in March, June, September and December. And it's not really until September that we're expecting more kind of changes around the balance sheet details, and then an eventual rate hike that most believe will still occur in December. But nonetheless, that will be something to monitor, and could well be the case that given now we're getting these more summary type volume conditions in the market, then we could be defined by these more or bounded by these technical levels, with people not wanting to commit ahead of that event. So something to just bear in mind. I'd be trying to identify those levels, particularly in the equity space, quite closely. Currency-wise, this morning the dollar index has actually recovered a little bit from late Asian trade, so we're pretty much flat. So you can see as that dollar has recovered, though, slight downside pressure in the major pairs. Euro dollar and cable sitting just below their respective pivot levels. Just looking at some levels here that probably Sam would have had marked up, covering with you guys from yesterday. This would have been the Draghi-inspired rally in the euro with his optimism and his assessment in that latest press conference. So I guess the big downside levels, given we're just trending a little low here at the moment, would be the low from yesterday's session. That was also the early morning and late afternoon low around that 116.62 type level. And then below there on the intraday you've got 116.52, which was also support on the immediate aftermath, the evening of the press conference last week. Any break of there obviously starts to then bring into sight S2, which is also fairly close to the high that was seen on the 18th, sitting just below. So S2 at 27, that high was seen back on 116.22. So a couple of levels to look at should we start to see if there is any case of profit taking and maybe a bit of a dollar rebound given some of the weakness that the dollar's seen. I understand that the dollar yesterday was up about 0.2%, so bucking a trend, what has been a pretty persistent pattern of selling for the US dollar. Albeit, granted, probably more the dollar index weakening on the back of some of this euro strength that we've had of late. Okay, quick look at some other things, and something which jumped out to me, although it's not major news, I guess for some of the new, or some of the trainees who are newer to the marketplace, particularly the fixed income sphere, is I saw that there was a US bill auction yesterday, 3-month auction. So we're talking about a much shorter dated maturity in the curve. You guys are more used to looking at things like bunds and T-notes, which is obviously the benchmark kind of 10-year. We're looking at a T-bill, which is basically sub 1 year. So 3, 6, 9 month, 12 month type money. The 3-month is normally deemed for more kind of cash management purposes rather than longer term maturities. So you tend to get short dated debt that rolls and gets renewed quite often. Now what was important yesterday is the US T-bill curve inverted after a weak 3-month auction. Now why would that happen? Well, let me just have a look at a few different things. Now, one of the reasons why this is important is because coming up in early to mid-October, basically the US is going to run out of money as far as the debt ceiling is concerned. So at any given point in time, Congress would have signed off a threshold of the amount of debt in which the US can take on. As we know, they run a deficit, a fairly sizable one still at the moment, and so at this point in time, to manage this and make sure that that debt problem doesn't spiral out of control, the US impart what is called a debt ceiling. And so the US government can only fund itself up until that ceiling is hit, and basically at this point the Congressional Budget Office, which is the CBO, are saying the US Treasury can fund the government through early to mid-October under the current borrowing limit, giving lawmakers leeway to wait until after their summer recess to increase the debt gap despite pressure from Trump to act sooner. So Trump's obviously been pushing, look, we need to bump this debt ceiling up, have an agreement on that before the summer recess. The summer recess, they'll go away, and this basically puts on pressure to them to strike a last-minute deal to move that debt ceiling higher. Obviously, if not, then, and this has happened before, the US is unable to pay its various social security bills and so on, kind of public sector stuff. Now, what happened yesterday was, obviously we're in at the moment the end of July. We're not looking yet until potentially the US government running out of money until October. But if you think about it, this is a 3-month bill that was for sale. So August, September and October. So what 3 months encapsulates is people's appetite to want to buy a shorter dated bond or bill that would essentially capture the fact that the US could hypothetically then not have enough money in order to pay some of its obligations. And so therefore, although this wouldn't technically really happen in reality, default risk rises. And so what tends to happen is the 3-month auction yield has shot much higher. So yields at the very front end of the curve are moving higher, because what's happened is this is the demand side, so the bid to cover, the amount of bidders offering for that auction fell to its lowest level since June 2009. So I'm the government, I'm offering to sell this 3-month auction, and we've got the lowest amount of people wanting to buy that debt in 8 years. What does that mean then? That the price of the bond would decline theoretically, so driving the yield higher, and that's what you're seeing here, the yield shooting up. That then leads to an inverted yield curve in what we're seeing in the 3-month part of the curve in the US. So in typical times, a normal yield curve would normally have a higher yield, a longer duration. But if you think about this in a much more shorter time frame, so if we're looking at, say, 3 months going further out, essentially what's happening is you're paying for a higher yield now, but anticipation that yields are then going to decline in the future. Now, an inverted yield curve has been a fairly good barometer historically of predicting of a recession, particularly when it comes to the US economy. We had an inverted yield curve back in 2000, and then that led to the recession that followed thereafter. So it's got a good track record. Now, I'd say you wouldn't want to read into this too much, that saying the US is going to tip into recession. But even in the other longer dated parts of the curve, it is getting quite interesting. But this is, again, hopefully makes a bit more sense from the interns when you've done your fixed income lectures. This is quite unusual, but this is pretty much compensating for the fact that there is an inherent default risk associated with the specific time frame of which being covered, given the debt ceiling is looming in October. So if you were reading about this morning on Bloomberg or Reuters, this is the repercussion of what that sentence means. So I hope that makes a bit more sense. Okay, going back to the charts, one thing obviously that did see a bit of movement yesterday, and I'm just looking at it here now and sharing with you, is crude oil, almost back to heading towards 47. I can see quite a few levels here that I'm sure Sam would have been talking you through yesterday, but we hit a high here, very early Asia Pac session, kind of just short of retesting that at 46.70. Any push above there, then you've got that low that was seen on the 20th. You can see already marked up here, 46.81 ahead of R1 at 87. But a pretty decent push on the upside throughout yesterday's session, and obviously the talk of the town was St. Petersburg, where OPEC and non-OPEC meeting was taking place. So all the big players there, you had Saudi Arabia and Russia, most notably the two biggest kind of counterparts. And the main headline reading was that Saudis pledge deep export cuts. I was here at the point where I did catch this headline earlier in the morning. Saudi Arabia will cap shipments at 6.6 million barrels a day in August, 1 million lower than a year earlier, according to basically their energy minister or oil minister. And so this is, I guess, a slight elevation in, I guess, tactics from an OPEC point of view. Certainly what is important here is that it's the people, specifically Saudi Arabia and the likes of Russia, whenever they're making comments, obviously they carry a much more higher influence on the price of oil. But going forward for the week, I'd say the inventory data, obviously we're going to be looking out for later on this evening, the APIs and the DOEs to follow. Whether or not this price can make another concerted push up towards, I guess, the bigger near-term targets would be the high that we had on, just going back to Thursday, I guess, last week at 47.74. If you start looking at that longer dated, that's a fairly significant when we get up at these price points. Because if you start looking on a daily chart, obviously if we go above those levels, it's taking us back to really the beginning of June. So you've got a pretty substantial kind of area of potential resistance around 47.32, 47.55. We are trading roughly around $1 from that at the moment. Obviously, OPEC have now finished their meetings in St. Petersburg, but that doesn't mean that I wouldn't still be just keeping a half ear out. But I would imagine that OPEC feel they've done their job. They've managed to bump the price of crude up through some of the commentary yesterday. I don't feel there's much need for them to be out adding further commentary today when they've managed to basically add $1 to the price through those meetings. Don't forget their objective here is to keep oil up around the kind of higher band towards 50, where it's kind of beneficial for both shale and OPEC in that respect. Okay, quick look at the calendar for today. We've got German IFO coming up, so I really want to wrap this up and get off the mic before that data comes out. German IFO, obviously important because it is a soft piece of economic data, and what we're concerned with is companies, specifically IFO is a survey of 7,000 companies across multiple different sectors in the German economy, asking them basically about their confidence of forward-looking conditions over the next 6 months. Hence then, this gives us a pretty good barometer of sentiment within what is the kind of engine room of Europe. So IFO is going to be important. I'd be keeping an eye on the European assets in response to that economic data coming out. So you've got German IFO here. Looking at the trend of IFO, what it's been telling us is that as far as German businesses are concerned, the last reading was the highest reading since the series began in 1991. So you're looking at multiple decade highs of German business confidence at the moment. So we've had a pretty good run on this figure. The consensus estimate today is expectations on the headline 114.9, so a little bit of a drop off, but still keeping this elevated pace overall. So I would say the bigger market reaction would probably be if we saw a big downward number. Given that the number is so high at the moment, probably an upside figure would be unsurprising given we're already at these very extended levels. Going through the rest of the session, really not much else on the docket for the morning for economic data, but going into the US, housing data, these Case-Shiller numbers are really unimportant from a market moving perspective, but you do have Richmond Fed figures coming out, and then really, again, fairly quiet in the States from a data point of view. So again, with the Fed coming on Wednesday, I would try to, if there's no unexpected news, probably factor in you could have a more technically oriented range-bound type session. So identifying key technicals will probably carry a more greater influence on the market price movement today specifically, because fundamentally people are waiting for the bigger events forthcoming. Keep an eye on earnings coming out as well from the US, some of the bigger names to be aware of: AMD, McDonald's, 3M, Caterpillar, AT&T, General Motors. So there's still a few to just hear out or keep an ear on the squawk for. And then finally, from a speaker's perspective, Andy Haldane, they've got here Dove. I would say he's a kind of a dove masked in a hawk's clothes at the moment. Tends to be the description, I would say. He is a nude, his new kind of economy assessment has been erring on the more hawkish side. He's not gone as far as voting for a rate hike as yet, but you would say he's moved away from the majority group and is starting to head towards McCafferty and Saunders on the more hawkish side. There's apparently no text to be released, but that's at 6 o'clock. Maybe just something to be aware of at that time if you're still in the marketplace. Okay guys, 5 minutes to German IFO. Gonna leave it at that. Have a good day, and I'll see you in the chat room if any questions. Thank you.